Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin. With us rounding off the third quarter of 2022, I don't need to tell you that the year has so far been pretty crappy for markets and economies as a whole. Not only have we seen markets in North America down because of pressures like inflation, rising interest rates, but we've seen very severe events in other countries, such as the recent government default of Sri Lanka, which has put that country in quite a bit of turmoil and led to a severe shortage of various important goods. So when I show you a chart like this of an asset dropping roughly 20% in just under 2 months' time, it's probably not all that shocking, right? You're probably thinking, Richard, show me something interesting. Those are rookie numbers. But while this might not look all that drastic in the context of 2022, it is actually quite surprising because this is a chart of a 10-year gilt, a 10-year UK government bond, nicknamed gilt because the old certificates used to have a gilded gold edge. And according to traditional portfolio management, government bonds from developed nations like the UK are supposed to be some of the lowest risk assets that individual investors can own. So to see this kind of volatility is quite surprising. And it gets even worse when you go to longer term bonds that are due over a longer period of time. With the 30-year gilt, for example, dropping 45% over that same time frame. And this is by no means the only thing in the UK experiencing volatility right now. Just last week, the pound hit its lowest value against the US dollar in history at $1.04. And outside of stocks being down, we've also seen some uncertainty in the space of mortgages and lending activity, with some products actually being pulled out of the market by different lenders, as well as, importantly, pensions, where people's retirement savings have actually seemingly gone through the ringer this past week, being put very much at risk. So much so that just last week, the Bank of England intervened, promising to put forward £65 billion to purchase gilts or government bonds and to help stabilize the market. Carrying out a complete 180 with its plan to shrink its balance sheet and carry out quantitative tightening where it would sell bonds, and instead further extending its quantitative easing program that has been done since the 2008 financial crisis to help support capital markets. And I've already seen people online making fun of this, saying, here we go again, money printers starting back up. We're going back to 2021, where central banks provide endless support for the stock market. But while there are valid concerns behind that criticism, I wanted to cover the event not only to explain what exactly went down and why we're seeing this volatility in the UK market, because as you'll see, it gets a little complicated, especially when it comes to the pension side of things, but also because a lot of people have described the past week as being a near Lehman Brothers crisis for the UK, which, if you aren't familiar, is the financial institution that unofficially kicked off the 2008 financial crisis when it itself went bust. So obviously very alarmist and tall claims, and I want to explain things plainly without those kind of headlines, but also to explain why what we're seeing in the UK isn't close to what Sri Lanka went through, for example, which, as we mentioned, the government there recently defaulted and led to a collapse of that country's economy. So what's going on across the pond? Well, much like elsewhere in the world, the UK is experiencing a slowdown of economic output and the risk of a recession at a time where it's likewise experiencing very high inflation. In fact, many have described the country as experiencing a cost of living crisis, thanks in part to the war in Ukraine, which has reduced the supply of natural gas and increased energy costs for the country. With the cost of feeding a home increasing 250% since 2018, so in less than 5 years' time, to roughly £2,500 annually for the average household. And while sometimes easy for us here in North America to forget, the country is also still reeling to an extent from its Brexit, from its exit from the European Union, with the Organization for Economic Cooperation and Development estimating that the cost per household in 2020 for Brexit was roughly £2,200. And with all these factors combined, even though we don't have the official figures yet, the Bank of England has announced that it already expects the UK to be in a recession. So far, well, obviously negative news, nothing overly surprising relative to the rest of the world. But then steps in Liz Truss, the Prime Minister of the United Kingdom. You might remember that Boris Johnson was ousted thanks to Partygate, thanks to having parties during COVID-19. And since taking the position in early September, Liz Truss has already made some pretty big moves to try and not only turn around this economic decline, but to try and control this cost of living crisis, including the overturning of a ban on fracking, which is a water-intensive method of extracting oil and natural gas from shale rock. And on September 8th, announcing a price freeze for energy, a £150 billion program that is going to subsidize the cost of energy to be entirely funded with debt, the issuance of government bonds. Now, generally speaking, more borrowing at a time where the cost of debt is actually rising as central banks try to fight inflation is generally not expected to bode well. But things really kicked off on September 23rd when British Finance Minister Kwasi Kwarteng announced a mini budget, proposing that the government would not only cancel a planned hike in corporate taxes, reverse a recent tax hike for payroll taxes, but would actually cut taxes, including a tax cut for people who earn more than £150,000 a year, with Kwasi Kwarteng being quoted saying that this was to make Britain more competitive and would incentivize growth. Now, obviously, cutting taxes for the wealthy, not the most popular move, but it's also what kicked off the decline of the British pound, leading it to reach that lowest point against the US dollar in history. So why the severe market reaction to these stimulus measures? Because as you might know, tax cuts and subsidizing prices are stimulus measures to try and encourage activity to save households money so that they can spend more money and demand more goods, thereby helping the economy. Why would markets react negatively to this? Well, it appears investors question whether the benefits here will outweigh the extra costs of this new government borrowing. Because remember, interest rates are on the rise. That makes those interest payments that the government will pay on this new debt higher and more expensive. And so many investors sold off their gilts and caused the yield of these instruments to increase, effectively meaning that they were demanding a higher return to hold government debt. If you remember, price and yield, or the fixed income return on these types of instruments, inversely related. If price goes down, yield increases, and sort of funny enough, that itself increases the cost of new government debt, because if investors are demanding, say, 5% on these government bonds, then the government will need to issue new bonds at 5% if they want anyone to lend that money. On top of this, many are concerned that these moves will actually make the record high inflation that the country is already experiencing even worse. And there's quite a bit of merit to those concerns. If you define inflation as too much money chasing too few goods, well, we definitely have the too few goods, especially in the energy market there. But if you add stimulus to try and increase household spending, you're just adding more fire to the too much money side of the equation, which obviously isn't going to improve things. So in pursuing the stimulus measures, the government is actually actively working against the Bank of England, who itself is trying to fight inflation by increasing interest rates, which generally might depress lending activity and help reduce those price increases. And because all this has led to a decline in the value of the British pound as investors sell off British goods, which causes that pressure, it's also led to an increase in the price of imports for the country. So it's actually led to inflation in other areas because it will cost more in British pounds to purchase non-British pound goods when you consider exchange rates. And a lot of people have criticized Liz Truss and Kwasi Kwarteng here for the moves here, so much so that even the International Monetary Fund, the IMF, stepped forward and said that the government should reevaluate its plan and what it's going to do moving forward. So that's the baseline of the story here, but that's really only half of it, because later in the week, we had the big update that the Bank of England was intervening, that they would reverse course on their plan to sell bonds and would actually start buying gilts to try and save the pension sector, with the bank promising that starting September 28th, it would buy up to £5 billion of gilts every day to help support the market. Now, given the concerns we highlighted earlier, this might sound surprising. Why is the Bank of England stepping in to stimulate the economy when they're concerned about high inflation rates, which is really one of their key mandates as a central bank, is to control price increases? Well, as mentioned earlier, it has a lot to do with pensions, because as gilts are being sold off and yields in the area were rising, a lot of pensions experience a near liquidity crisis, thanks to a number of them all trying to sell gilts, the government bond, at the same time when there weren't all that many buyers in the market. Now, a full explanation of this could get really complicated because it involves derivatives and pensions, which if you've taken accounting classes, you know that pensions get a little complicated, especially when you talk about defined benefit pension plans, which are the type of pensions here at the core of this problem. But more or less, they're pensions in the UK that offer a defined benefit, a fixed amount that they promise they will pay their pensioners in retirement, regardless of what the market does. Now, traditionally, pension plans might have used bonds to try and match their liability here so that they have the perfect amount of assets to pay for these obligations over time, that they will meet their fixed needs based on the promises of this plan. But a lot of these plans today, because of how low interest rates have been, are not fully funded. And so to make up the shortfall, a lot of pension plans invested in growthier assets and then used derivatives to try and offset their interest rate risk. With this fixed liability that you have with pensions, when you carry out a present value calculation, which I'll leave the formula here, I don't think that'll help, but with the present value of this liability, this fixed amount, that will change every time interest rates change. So if interest rates rise, that liability will decrease and the program won't require as much funding. If interest rates decrease, the value of that liability will increase, meaning that the program will require more and more funding and will become more expensive if interest rates fall. So to try and offset that, these pension plans entered into derivative arrangements that if interest rates fell, the value of this arrangement would increase to offset that increasing liability, and vice versa. So basically they're hedging their exposure. They entered an asset that reflected their liability, so that if the liability rose, the asset would rise, and vice versa, to help offset that obligation. Now, because these are derivative investments and introduce leverage, they are subject to margin calls, meaning that they can decline in value by more than what you've actually put up for this investment. So they might be forced to add more cash to the account if they experience a severe drop in the value of this derivative. And that's basically what happened. A bunch of pension funds sort of experienced a margin call where all of a sudden they needed more cash on hand to fund their derivative investments that were hedging their portfolio. And that forced many of them to sell their gilt investments that they held as assets within the pension fund to fund that obligation. And this contributed to a liquidity crisis that threatened the solvency of a number of pension funds, where all of a sudden everyone was trying to sell gilts in the market and there weren't all that many buyers. And that forced the price of the gilts to fall further, which only exacerbated the situation as more margin calls ensued. As a senior London-based banker noted, at one point on Wednesday morning, there were no buyers of long-dated UK gilts. And that's why the Bank of England stepped in as a buyer for gilts. They were offering liquidity in this market where all of a sudden buyers had dried up and pension funds couldn't get the money they needed to meet their derivative-based obligations, meaning that, as mentioned, some of them were at risk of failing, which, needless to say, would be pretty bad for the economy as a whole. So, what now? Well, the move from the Bank of England has settled the gilt market, with yields for gilts dropping from above 5% to below 4%. And again, that reflects the costs that lenders are effectively imposing onto the government. So that's a good sign for the government. And in addition to gilts recovering a little bit, so too has the British pound, which has jumped from its low of $1.04 to $1.11 as of Friday close. So for now, it appears that the storm has settled, but nonetheless, the actions of the government here do threaten to prolong this period of high inflation with a questionable benefit on the gross domestic product side of things. And even though these actions were at first targeted at controlling energy prices, they might have simply shifted inflation elsewhere. As for the Bank of England side of things, they have stressed that they are not trying to lower long-term interest rates, but that this was strictly done for liquidity purposes to help ease the market in the short period of time until things normalize. Still, it could have that impact on inflation and make things worse as long-term interest rates still have declined, as shown with long-term yields. Now, again, this has been compared to a near Lehman Brothers type moment where liquidity dries up in the financial markets. But comparisons to Sri Lanka, for example, are really overblown. There is a key distinction here, which is that obviously the UK, a more developed nation, more stable economic output with less political corruption, which was a big issue behind Sri Lanka's own fall. Not the only factor, but a big one. But on top of that, a lot of the UK's external debt is actually denominated in the British pound, which is a huge advantage because even if your currency is devalued, it doesn't really make that debt harder to pay off because it is denominated in the currency that is becoming less valuable. It can actually, in real terms, make that debt easier to pay off. Now, I know here in North America, a lot of people don't care too much about what's happening in Europe, unfortunately, but it is still important news, right? The UK and London even are very important finance hubs, and we're the biggest finance hubs in the world at points. And even though Brexit has somewhat impacted that, it remains a very important market for Europe as a whole and globally, because any slowdown in Europe would still be felt in North America, for example. So it is still worth knowing these events, but one of the main reasons, again, I wanted to cover it is, again, people talking about the Bank of England printing money. And sure, I know that those comparisons can be made. Still, it is worth highlighting why this action was done, that the country did nearly experience a liquidity crisis, and it's not as black and white as a lot of people paint it. It's not to say that these actions are all justified. Even with the Bank of England, there are arguments against the moral hazard that this could create. I mean, 2008 is a prime example of this not being the first time that market participants have used models to oversimplify very complex derivative products and then kick off a devastating chain of events when those assumptions are violated. It is to say that there is more to it than simply money printer go. So that's the video. I hope you enjoyed it. If you did, please do make sure to like and subscribe. It does help the channel tremendously. And let me know your thoughts on all this that's happened in the comments down below, especially if you're someone who lives in the UK. I would love to hear your thoughts on the political side of things, and even at your household level, how you've been managing through these times and what your thoughts are on the actions that have been taken. Thanks for joining me. And as always, be safe out there.